Welcome back. Thank you so much to my colleague Nzinga Qunta for holding down the fort. My name is Arabile Kumeta. I'll be with you until 3 p.m. then as we continue the rest of On Point. With that, though, let's take a look at how the markets are performing and kick things off then out in Asia in particular. A fairly flat stance for some of Hang Seng, the Hang Seng stocks out in Hong Kong, then seeing a tinge of negativity as well at the Shanghai Composite, while the Nikkei was the only one sort of edging out in some positive territory there. It does seem that things are beginning to slow down ever so slightly, as well as the issues between the United States and China still coming to the fore as well. But a bit of a down day as well out of the Dow Jones Industrial out of the United States yesterday. Europe today also continuing what was the negativity from yesterday, even if it is only just a touch lower when it comes to the FTSE 100, 0.2% there. The CAC 40 in France is down 1/3% as well. On the local front also, negativity continuing. We're now just below the 54,000 point mark, and we are down nearly 1% today. The banks going down 2.5%, the biggest losers today, as the financials also dipped down 2.33% overall. The industrials are pretty flat across the day, while the gold indices have pushed down the resources, which are down 1.75%. Onto your commodities board, well, the oil price continues to dip down. It's now fallen more than 2% today and sits just above that $40 a barrel mark right now. Perhaps the questions around demand not necessarily aiding the market too much as demand begins to pick up, but not enough, unfortunately, to raise the price of oil. Platinum and gold then also having differing fortunes in this afternoon trade. Platinum going up, or rather going down 0.2% there, $832 a fine ounce, while the safe haven trading of gold has seemingly helped it quite a bit there, $1,721 a fine ounce there. In your currencies, a much better stance for the local currency, 16 Rand and 53 cents there against the US dollar, so around 0.2% better off. It's 18.81 for a euro and 21 Rand 13 for a British pound. Michael Traherne joins us now. He's from Vestact Asset Management, and we get to unpack this market picture a little bit more with him now. Michael, thank you so much for the time. One of the key elements that have certainly plagued the market or factored into the market right now has certainly been this oil price, which has gone all the way down below $30 a barrel, now sitting just above 40. We thought with more demand that price would go a whole lot higher. Seems to be pretty stagnant where it is right now.
Yeah, I mean, let's not forget, was it in the depths of March or early April, U.S. oil price actually went into the negative briefly. So it shows you how much oil has rebounded. But the big thing is global economy is still not fully out of lockdown. So demand isn't where it needs to be. Over the weekend, OPEC Plus met and they agreed to keep their massive cut in place for at least until their next meeting. So that's the reason why oil rebounded to 40. But let's not forget that there's still a lot of oil sitting in storage around the globe. And the frackers in the US are now turning on their taps again now that it's at 40. So it's very much demand supply struggle. And if you're sitting in South Africa, you very much want the oil price to head down again.
Yeah, and speaking of heading down, I mean, many people would obviously complain that it's just not going down enough because, yes, we saw nearly 4 Rand in terms of drops over the past 2 months, but then, unfortunately, had this month going up by around a Rand and a little bit more. In terms of pressures, though, facing not just the U.S. market as it goes back into that bull market territory, particularly for the NASDAQ, has the market run a little too hard and too fast and sooner rather than it should have been?
Yeah, I mean, the big part of the rebound has been led by tech stocks. Before the virus and the shutdown, technology was important, but the virus has really highlighted how important it is to be part of these technology companies. You can't work from home if you're not on the internet, if you're not using these technology companies, if you're not using Amazon online delivery, that sort of thing. So we've really seen a very strong power from tech stocks. And last night we actually saw the NASDAQ, which is a very tech-heavy index, breaking 10,000 points for the first time. So it's highlighting where the response has come from. Last week, Friday, we saw a very strong jobs number come out of the U.S., and that's also pushed the market a lot higher, particularly the like tourism stocks. So market busy pricing in what they would call a V-shaped recovery, or at worst case scenario, a bit of a U-shaped recovery.
Yeah, so we'll see how that fares. The Fed's announcement, though, later today should also be quite key and critical, shouldn't it? It will tell you then they're going to make their first projection on economic growth since December, and surely this is bound to be a big announcement later today.
Yeah, so any forecast coming out now is very much a thumb suck, and the market probably won't be paying too much attention to it. What the market will be looking for is any talk of potentially negative interest rates in the US. So if you look at Europe, Europe already has a vast countries with negative interest rates. The US have said that they don't think it's necessary, and it might actually be detrimental to the economy. But let's see what Jerome Powell says this afternoon. Negative interest rates is another thing that would be pushing share prices higher. With the zero or negative interest rates, when you're calculating what a share price, what a share is worth today, you have to look at future profits and you discount them back to today. So a zero interest rate, negative interest rate definitely makes share prices today worth more.
Yeah, so no real announcements with regards to interest rates really expected today in that course. But as you say, the negative interest rate projection or possibility of thereof is certainly something to look out for when it comes to that market. Let's turn our attention a little bit locally now. We've got the rand improving to around 16 rand 53 odd against the US dollar. So certainly a good mark on that front. But not everybody is improving, unfortunately. The property market seems to be suffering quite heavily.
Yeah, it's been really tough. If you're a property market mall owner, April there was a complete shutdown. Hyprop actually came out with a trading statement this morning saying foot traffic in their malls for April were down 70%. It has improved since May and in June. Currently, they say that the foot traffic is still down 25% compared to the same time last year. So it shows you how tough it is out there. Property stocks, part of their lease agreements generally include a share of revenue from their tenants. So even though most of their tenants are back at work and working again, their rental income will be really tough. I suppose the only saving grace for the property sector at the moment has been the lower interest rate, which potentially helps them on the interest side of their income statement.
Yeah. Does the market begin to pick up, though, considering, as you made note of, the lower interest rates, which may not be there for too long, but, it does create an environment that enables people to want to form part of, whether it be a housing market, retail in terms of vehicles as well, taking up some form of credit. Does it help the property stocks perhaps later on, the likes of Growth Point in particular?
Yeah, so if you have a look at the property stocks, 23rd of March was the global market low for all stocks. Property stocks were included in that. Since then, they have more than doubled in value. And part of the reason is that this lockdown is potentially being, or markets are opening quicker than expected, particularly in areas outside of your infection hotspot. So investors are saying, look, we expect these guys to survive. Part of the concern going into March and early April was that the property stocks had far too much debt on their books. And if you've got lots of debt with no tenants paying you and you still have to pay off that debt, it creates a really difficult position. Most property stocks so far that have actually said that they're not going to be paying a dividend for the next year because they need to shore up their balance sheet. So if you are brave, potentially it's one to look at, but no doubt it will be a very, very volatile holding.
Look, it's a brave new world nonetheless, so perhaps it's not such a foregone conclusion that people won't get into what should be a brave stock indeed. But Michael, thank you so much for the time. Really appreciate it. Michael Traherne there from Vestact Asset Management joining us to help unpack this market movement for us then. We get back to you right after the short break though, and when we come back, we take a look at some economic news and really some conditions around business confidence in South Africa. All of that coming up